October 29th, 1929. The floor of the New York Stock Exchange is a scene of absolute devastation. Clerks are screaming, ticker tapes are piling up, and fortunes are vaporizing in seconds. In the midst of this financial apocalypse, a 35-year-old money manager named Benjamin Graham watches in stunned silence. His portfolio will soon lose 70% of its value, wiping out his wealth and threatening his future. The system has failed, and speculation has ruined millions. But out of this wreckage, Graham will ask a question that changes finance forever. What if the market is not a rational calculator, but a wild emotional beast? And what if there is a disciplined way to defeat it? To understand the depth of the 1929 crash, we must look back at the decade that preceded it, the Roaring Twenties. It was an era of unbridled optimism. America was industrializing at breakneck speed, powered by the rise of automobiles, radio, and domestic electricity. The stock market became a cultural phenomenon. For the first time in history, everyday citizens began buying shares of public companies. But this boom was built on dangerous ground. People bought stocks on margin, borrowing up to 90% of the money to make their purchases. Worse, Wall Street operated like an unregulated Wild West, devoid of government oversight. There was no Securities and Exchange Commission. Corporate financial disclosures were voluntary and often misleading, and insider trading was rampant. Stock prices were driven entirely by rumors, manipulation, and the expectation that someone else would pay a higher price tomorrow. The crash of 1929 was not just a correction, it was a structural collapse. It exposed a fundamental flaw in human behavior, the complete absence of a rational, objective framework for valuing a business. This was the environment that shaped Benjamin Graham. Born Benjamin Grosbaum in London in 1894, his family immigrated to New York when he was a child. His early life was marked by sudden instability. After his father died, his mother lost their savings in the panic of 1907. This childhood experience of poverty left a permanent mark on Graham, instilling in him a deep-seated fear of financial loss that would define his entire professional career. Despite these hardships, Graham was a brilliant student, graduating from Columbia University at the very top of his class. He was offered teaching positions in English, mathematics, and philosophy, but he chose to go to Wall Street. By the mid-1920s, Graham had already established himself as a highly successful money manager. However, the crash of 1929 spared no one, including him. The heavy losses he suffered did not break him. Instead, they ignited an intellectual obsession. He realized that the prevailing approach to investing was nothing more than high-stakes gambling. He set out to transform investing from a game of chance into a rigorous, scientific discipline. His goal was not to find the next hot stock, but to establish a system that would protect capital first and generate steady, reliable returns second. In 1934, alongside his colleague David Dodd, Graham published Security Analysis, a monumental work that laid the foundational principles of modern financial analysis. In 1949, he synthesized these ideas into a guide for everyday investors, The Intelligent Investor. Together, these books introduced a revolutionary way of thinking about the stock market. To Graham, the distinction between investing and speculating was absolute. He defined an investment operation as one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. The first core concept Graham introduced was intrinsic value. Before Graham, people viewed stocks as mere pieces of paper that fluctuated based on market trends. Graham argued that a stock is an ownership share in an actual living business. Therefore, a stock has an intrinsic value that is independent of its current market price. This value can be calculated by carefully examining a company's assets, earnings, dividends, and future prospects of the business. If the market price is lower than the intrinsic value, the stock is undervalued. If it is higher, the stock is overvalued. Over time, the market price will always gravitate toward this intrinsic value. To explain the erratic nature of stock prices, Graham created one of the most famous allegories in financial history, Mr. Market. Imagine you own a share in a private business, and your business partner is a man named Mr. Market. Every single day, Mr. Market appears and names a price at which he is willing to either buy your share or sell you his. Mr. Market is highly emotional. On his good days, he is wildly optimistic and names a very high price. On his bad days, he is deeply depressed and names a ridiculously low price. Graham argued that the intelligent investor should never let Mr. Market's mood swings dictate their own understanding of value. Instead, you should view Mr. Market's emotional instability as an opportunity. When he is irrationally depressed, you buy his shares at a discount. When he is irrationally enthusiastic, you sell your shares to him at a premium. This led to Graham's most critical concept, the margin of safety. Because the future is unpredictable and financial calculations are never perfect, Graham insisted that an investor must never buy a stock at its full intrinsic value. Instead, you must buy it at a price far below its estimated worth. If you estimate a stock is worth $100, you should only buy if it is selling for $70 or less. This $30 discount is your margin of safety. It protects you against unforeseen business downturns, economic crises, or errors in your own calculations. If things go wrong, the discount cushions your loss. If things go right, your profits are amplified. To put this into practice, Graham searched for what he called net stocks. These were companies trading at a market price lower than their net current asset value, meaning their cash and short-term assets minus all liabilities. In essence, Graham was looking for businesses that were selling for less than their liquidation value. He described this style of investing as finding cigar butts on the street, soggy, unattractive, but offering one free, satisfying puff left. Through strict adherence to these principles, Graham proved that patience and mathematics could systematically defeat the emotional volatility of Wall Street. The turning point came when Graham proved his theories weren't just academic concepts, they were incredibly profitable in the real world. His firm, the Graham-Newman Corporation, consistently beat the market for decades, producing outstanding returns with minimal risk. He transformed Wall Street's image from an elite club for gamblers to a legitimate profession governed by logical rigor. But the ultimate validation of Graham's ideas occurred in his classroom at Columbia University. In the early 1950s, a young student from Nebraska arrived to study under him, Warren Buffett. Buffett was the only student to ever receive an A+ grade from Graham, showing a rare, immediate grasp of the material. He was captivated by the simplicity and power of the philosophy. Under Graham's mentorship, Buffett learned to ignore the noise of Wall Street, focus on intrinsic value, and buy with a margin of safety. This teacher-student relationship altered the course of modern financial capitalism forever. Buffett took Graham's intellectual foundation and applied it on a scale never seen before, eventually turning Berkshire Hathaway into one of the most valuable corporations on earth. The success of Buffett and other Graham disciples proved that value investing was not a temporary trend, but an enduring truth. Benjamin Graham passed away in 1976, but his core ideas remain the gold standard of investing. Today, we live in a financial landscape that looks vastly different from the one Graham navigated. We have high-frequency trading algorithms, complex financial derivatives, volatile cryptocurrencies, and viral meme stocks driven by social media hype. Yet, despite these technological shifts, human nature has not changed. The financial markets are still driven by the same primary emotions that caused the crash of 1929, fear and greed. When speculation runs rampant and markets reach historic highs, critics often claim that value investing is dead, arguing that the old rules no longer apply in a digital age. But history shows that whenever speculative bubbles inflate, they eventually burst. When the dot-com bubble collapsed in 2000, and when the housing market crumbled in 2008, it was the investors who abandoned the margin of safety who were ruined first. Meanwhile, those who remained disciplined, adhering to the basic principles of intrinsic value, not only survived, but thrived in the long run. The true legacy of Benjamin Graham is not just a set of mathematical formulas or a strategy for picking stocks. It is a philosophy of discipline, patience, and emotional control. He taught us that the greatest enemy of an investor is never the market itself, but the person looking back at them in the mirror. In a fast-paced global world that constantly demands speed, immediate gratification, and conformity to the latest trends, Graham's timeless wisdom serves as a reliable anchor, reminding us that enduring success is built on a foundation of intellectual honesty, rigorous analysis, and the courage to stand apart from the crowd.